Welcome to Tesla Daily News Podcast. It's Sunday, January 18th, 2026. Today, we're tracking the stories that can actually move Tesla's business fundamentals and the stock: self-driving regulatory risk, monetization changes to full self-driving, Robotaxi execution signals, product and pricing moves for the Model Y, and intensifying competition, especially from China. First up, Tesla just got more time in a U.S. federal safety investigation into full self-driving, and that's a headline investors should not ignore. The hook is simple. Regulators are still asking whether full self-driving is breaking traffic laws while engaged. Here's the context. FSD is one of Tesla's highest margin, most valuation-sensitive products because it's software. Bulls model it as a major future profit pool. Bears see it as a regulatory and liability overhang. The details: U.S. auto safety regulators granted Tesla a 5-week extension to respond. Tesla now has until February 23rd to answer allegations tied to vehicles violating traffic laws while operating in what Tesla calls full self-driving mode. The impact for investors is a near-term uncertainty window. This doesn't automatically mean enforcement, but it keeps the regulatory spotlight on FSD's real-world behavior and on Tesla's marketing claims. Expect this to feed analyst questions about take rate sustainability, potential feature restrictions, and legal exposure, especially if a future remedy requires software changes that reduce convenience or capability. Takeaway: mark February 23rd on your calendar. If Tesla's response satisfies regulators, risk comes down. If it doesn't, it can translate into headlines, recalls, or constraints that matter to sentiment and to the software revenue narrative. Second story: Tesla is ending upfront FSD sales and moving to subscription only, starting February 14th. This is a business model shift with real financial statement implications. The hook: Tesla is changing how it sells one of its most profitable products. Context: selling FSD as a one-time purchase pulls cash forward and can boost near-term revenue recognition over time depending on feature delivery. Subscription pushes Tesla toward recurring revenue, potentially more stable, but it can reduce short-term cash per buyer. Details from reporting: Tesla will no longer sell full self-driving as a one-time, upfront purchase and will move to subscription only beginning February 14th. Impact: in the short run, traders may debate whether this is a demand signal, Tesla trying to lower the psychological barrier to adoption, or a regulatory and marketing response to avoid scrutiny around how full the capability really is. In the medium term, a subscription model can increase lifetime value if churn is low and if Tesla continues shipping meaningful improvements. But if usage is occasional, customers may only subscribe for road trips, lowering average revenue per user. Takeaway: watch for Tesla to communicate pricing, terms, and any bundling with insurance or Robotaxi. Investors should also watch next earnings for changes in deferred revenue dynamics and commentary on attach rate. Third, Tesla is hiring for a magical Robotaxi iOS app. Small headline, big strategic signal. The hook: Tesla is staffing up the consumer layer for Robotaxi, not just the car. Context: Robotaxi isn't only autonomy, it's marketplace logistics, onboarding, payments, routing, support, fleet visibility, safety reporting, and trust. Uber and Lyft are apps first. Tesla will need that same level of polish to scale. Details: Tesla is actively preparing for its Robotaxi service and is seeking an iOS developer to work on a Robotaxi app, explicitly aiming for a user experience that feels magical. Impact: hiring alone won't move revenue tomorrow, but it's a tangible execution breadcrumb that Tesla is building the end-to-end stack. For valuation, Robotaxi is the optionality lever. Any evidence the company is moving from concept to operational tooling can influence long-duration growth models. Takeaway: treat this as incremental confirmation that Tesla is building the commercial wrapper around autonomy. The key question remains timeline and regulatory clearance, but execution at the product layer matters. Fourth story: Tesla hit a snag trying to trademark Cybercab. This is not about vibes. This is about branding and rollout friction for Robotaxi. The hook: Tesla's Robotaxi naming plan just ran into a legal wall. Context: names matter when you're launching a consumer service. A blocked trademark can force last-minute changes to marketing, app listings, and brand cohesion. Details: the U.S. Patent and Trademark Office suspended Tesla's attempt to name its autonomous vehicle Cybercab, citing a likelihood of confusion. Impact: this is not a revenue hit by itself, but it adds friction and uncertainty around the Robotaxi go-to-market package. In markets where regulatory approval is already hard, Tesla doesn't need additional delays from branding disputes. Takeaway: watch whether Tesla pivots to Robotaxi, Cybercab, with a modifier or an entirely new brand. Investors should focus less on the name and more on whether production and service timelines stay intact. Fifth, Model Y gets a new 7-seat option for the 2026 model year, and it's priced as an add-on. The hook: Tesla is widening the Model Y's addressable market without launching a new vehicle. Context: in a slower EV demand environment, incremental configuration expansions can help Tesla defend volume and protect factory utilization, especially for its single most important product line. Details: Tesla launched a 7-seat version of the 2026 Model Y in the US. The third-row option costs an additional $2,500 and is only available on the premium all-wheel drive long-range trim. Impact: for margins, paid options are generally attractive. For demand, a third row pulls in families who are cross-shopping 3-row SUVs. The limitation only on a premium long-range AWD suggests Tesla is prioritizing profitability and production simplicity rather than chasing every price point. Takeaway: this is a smart, low-capex lever. Watch whether it expands to more trims and whether it arrives in additional regions, which would signal Tesla sees meaningful incremental demand. 6th, Taiwan opens ordering for Model Y performance with strong specs and aggressive financing messaging. The hook: Tesla is pushing the high-performance halo in a key import market. Context: international demand is increasingly shaped by local competition, financing offers, and refresh cycles. Performance trims can support ASPs, average selling prices, when base models are pressured. Details: reporting indicates Model Y performance is open for orders in Taiwan, highlighting 0 to 100 km per hour in 3.5 seconds, WLTP range of 598 km, a price of $2,499,900 new Taiwan dollars, and promotional purchase options like 0 down or monthly payments around 9,999 new Taiwan dollars. Impact: if Tesla can keep performance trims selling, it helps mix and margins. But the presence of prominent payment promos also hints at a market where affordability and monthly cost are central, something investors should watch globally as rates and incentives influence EV demand. Takeaway: focus on mix. Performance orders are good for revenue quality, but widespread promos can be a warning sign if they become necessary across regions. 7th and final, Chinese EV competition is accelerating into North America through Canada, and that matters for Tesla pricing power. The hook: Canada is reopening the door to Chinese-made EVs, potentially changing the competitive map. Context: Tesla's global advantage has been cost and scale, but China's automakers are strong on cost, features, and speed of product iteration. If Chinese EVs get easier access to North America, the pressure point is pricing, especially on high-volume crossovers. Details reported: Canada is lowering previously steep tariffs and will allow tens of thousands of Chinese electric vehicles into its market under a new trade arrangement. Impact: near term, Tesla's Canadian volumes could face new competition at lower price points. Longer term, this increases the probability of a broader North American pricing war if policy barriers soften further. That's the scenario that hits automotive gross margin and forces Tesla to lean even harder on software and energy for profit expansion. Takeaway: investors should watch Tesla's Canada pricing, inventory levels, and any localized incentives. Competitive import flows can show up quickly in order books. That's the wrap for today. The big themes are: FSD regulatory risk remains active with a key deadline on February 23rd. Tesla is shifting FSD to subscription-only starting February 14th. Robotaxi is showing both progress and friction through app hiring and the Cybercab trademark snag, and Model Y is still the lever now with a 7-seat add-on and fresh performance ordering in Taiwan, while Chinese EV competition is inching closer to North America through Canada. For tomorrow, keep an eye on any Tesla clarification around FSD subscription pricing and terms, and any follow-up reporting on the scope of the Canada-China EV import deal. Subscribe to Tesla Daily News Podcast for your daily, investor-focused Tesla briefing, and follow us for fresh updates every day.